Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. This is the week ahead for the week starting Monday, the 26th of August. Let's get into it. We have a big week ahead, and there's going to be a big focus on inflation, as we can see here with an overview of some of the big ticket items for the week. We have the likes of Australian inflation coming out. We've got Eurozone CPI, and we've also got Friday's core PC price index out of the US. Those are the main talking points, but we've also got a host of other readings. We've got a couple of figures coming out of Germany. This comes off the back of the sharp decline in both services and manufacturing PMI for the German economy. So we've got consumer confidence from GfK on Tuesday. We've got the IFO business climate number coming out on Monday. So the beginning of the week with a focus on Germany. But as we move throughout the week, you can see that we really crescendo into Friday, where we see that inflation rate coming out of the Eurozone in terms of CPI. That comes off the back of an inflation rate the day earlier from Spain and Germany. And then we also see that core PCE price index reading coming out later on Friday. So it really does feel like a week that is building up into Friday, where we see some big potential fireworks for traders. In terms of the first item I wanted to talk around, it is the US economy. Of course, at the moment, we've got big question marks about the strength of the economy, in particular the jobs market. We've just seen a massive downgrade in terms of the payrolls in the year to March. And really, it does highlight the fact that, you can look at some of this data, but months down the line, they might suddenly say, oh, that number that you've been trading around, it was completely wrong, and we've massively downgraded it. So it's a very interesting situation they've got over there. But ultimately, you're looking at a Fed that is back onto a dual mandate. So there's a focus on both the jobs market, so unemployment, but also in terms of inflation. And the inflation side of the picture will remain key. Markets really are expecting a lot from the Federal Reserve at the moment, with the fact that we've seen some weakness in terms of the data points. And so everyone's now pointing towards the possibility of 4 rate cuts this year, 5 rate cuts this year. And so meetings where we're seeing 50 basis point moves at a time. Part of the justification for that will come down to the fact that we've at least got the core PCE price index figure down to a reasonable level. That's below both the core CPI and the headline CPI number. And so a continued deterioration of that core PCE number on Friday will be key in really furthering the cause for a potential sharp decline in terms of interest rates going forward. You can see here we've got a host of other figures to look out for. And like I said, there is a big focus at the moment on the jobs market. So whilst we have got some big numbers, the likes of core durable goods on Monday, the likes of the second estimate for the GDP figure, there's going to be a big focus on that initial jobless claims figure. Once again, we saw an uptick to 232,000 last time. This time expected 242. So the further we move towards the upside in terms of initial jobless claims, the more people believe that the Federal Reserve are being backed into a corner and that they need to start cutting rates at a pretty dramatic clip. As you can see here, core PC expected to come in at 0.2% on a month-on-month basis. And certainly when we're looking in terms of the chart itself, we can see here that the downward trajectory has taken us to 263. It's been a very sort of clear-cut trend, but it's been relatively gradual in nature. Now, if we're looking for this time around, we want to look back to what's coming out from last time. So you can see July of 2023, the figure that's dropping out is 0.12%. Relatively low. You can see that's below the figure that we've seen, 0.182 from last month in terms of the core PCE month-on-month figure. So with markets expecting the 0.2 number, you can see that replacing the 0.12 with a 0.2 or somewhere near that means that by and large we're unlikely to really go anywhere in terms of inflation this time around. You can see in September, once the September figure stripped out, that's when we're going to see probably a nice bit of disinflation that time around. There's a good chance that we essentially stay in the mid-twos for the time being. And certainly if we were to see an uptick in terms of headline core PCE, that could actually sort of ease back on some of those claims that we're going to see a dramatic rate cut in September. Certainly, if we're looking in terms of market expectations, this is the outlook for December. So essentially, according to the CME with the FedWatch tool, Where are rates going to be by year end? You can see on the far right hand side is the 525 to 550. That's where we are at the moment. So essentially, we're looking as the base case scenario for a move back down to 425 to 450. So we're looking for 4 rate cuts in 3 meetings. That means one of the meetings is going to have a 50 basis point move. And that essentially I would say is pretty dovish, and certainly if we were to see an uptick in terms of inflation, that could potentially rein in some of those expectations. What happens to markets when you see expectations of significant rate cuts from the Federal Reserve? Well, what have we been seeing recently? We've been seeing weakness in terms of the US dollar. We've been seeing strength in terms of the likes of gold. We've been seeing strength in terms of equity markets, despite the whole unwinding of the dollar yen carry trade and some of the jitters around the tech sector. So we would be expecting, if we were to see inflation coming in towards the downside, we would expect to see more of the same, more weakness in terms of the US dollar, more upside in terms of gold, more strength in terms of the equity markets. The flip side of it is, if we saw an uptick in terms of inflation, we could see the opposite coming into play. Now, I wanted to highlight gold on this occasion, in part because of the fact that I generally always sort of grab onto the indices space and the FX markets, in part because we're covering economic data, and it's always easier to tie up, US data to US markets, or European data to, the euro and things like that. But certainly the relationship between the US dollar and gold is very clear and long-standing. So first and foremost, this is the outlook on the daily time frame. We can see here that there's been a pullback here on Thursday. We're coming into Friday, heading into the weekend, starting to recover once again already. The long-term trend shows you we're very much in a bullish market here. And you can see the long-term trend ultimately is very bullish for gold. So this is a market that should perform well over the long term. We just do get caught up in very protracted periods of consolidation sometimes. We're not in that at the moment. We've broken out of a consolidation phase once again here, and we're pushing upwards. We're reaching record highs on a regular basis. The 4-hour chart does highlight the trend that we're seeing at the moment with this creation of higher lows and higher highs time and time again. The latest pullback to me is a likely retracement before the bulls come back into play. And you can see the 61.8 really providing the support on this occasion. Now, we're not out of the woods in terms of the bears sort of being in charge for the time being and sort of seeing this this rally retrace somewhat. You can see ultimately we have seen a sort of ABC style retracement, but nonetheless, until we see a breakup through this 2519 level, we could once again roll over. And certainly if we were to see inflation move towards the upside, we could potentially see some strength in terms of the US dollar, and that could provide the move back into this zone, this deep fib zone between 24.55 and 24.70. But for me, I remain bullish, even if we do see that pullback, because we are moving into this phase where the Federal Reserve are likely to be moving in a pretty hasty manner, despite the fact that maybe inflation will take a little bit longer to get back down to target. We are ultimately moving into a period where we're expecting to see the Fed cutting rates pretty much every time we see them. And that should be good for gold. And historically, it always has been. And also that should be bad for the US dollar, which generally is good for gold. So near term, yes, we could potentially see weakness if we see a strong inflation print. But whether we push up through 2519 now or whether we pull back into this deep fib zone and then start to rally, I'm essentially bullish unless we break that 2431 support level in gold. The next area I wanted to talk about is the Eurozone area. Now, we've got the Eurozone CPI inflation figure coming out on Friday. The precursor to that is the Thursday. There are reports coming out of Spain and Germany. And we've also got a couple of surveys coming out of Germany earlier in the week, the IFO and the GfK figures. Germany certainly is in trouble at the moment, and the PMI numbers essentially point towards that. So the ECB will want to cut again. We have heard some sort of tones coming out of the ECB to highlight the willingness to do that. And the ability to see inflation back down to 2% will be part of that story. As we can see at the bottom here, the inflation rate is forecast to drop from 2.6 to 2.2%, core figure down to 2.8%. But really that 0.4% decline in that headline inflation rate could really highlight the possibility of the ECB really acting in a very forceful manner to be able to lift the economic fortunes of the region. And so the question mark is, do we see that move first and foremost? And, what's the market reaction going to be? Here's the sort of breakdown for inflation as it stands, 2.58, or as we've highlighted, 2.6 if you're rounding it up. And you can see in terms of the August figure from last year, this is where the base effects come into play, 0.54. So the view is, with the last figure coming in essentially flat at minus 0.03, if we saw another figure of 0% essentially, then we'd see even more disinflation. We could even see a move back down to 2%. That seems unlikely, but certainly if we're looking at prior months, something around the 0.2% mark would be in line with what we've been seeing recently. And that's where you get that 0.4% decline, because we're getting such a significant figure dropping out from last time. This is essentially the best opportunity to see that disinflation come into play, because as you can see, September of last year, we see a figure significantly lower, and then lower again for October. And then November, we've got this massive negative figure. So we're likely to see a significant uptick in November. But for the time being, we get the opportunity to see this disinflation move that should really lift hopes for a very dovish ECB. Now, in terms of the market to watch, I wanted to highlight the euro against the Swiss franc, because the Swissy has been a really interesting one. Now, ultimately, the Swiss have inflation well below that of the Eurozone, and they've been cutting rates ahead of time. But the fact of the matter is their rates weren't particularly high to begin with. So much like how the BOJ are raising rates, but their rates are very low, it's that relative move that's coming into play. And we're likely to see a similar kind of thing in terms of the Swissy, because the Swissy have already pretty much done all the cutting that they're likely to do. We might see one more, but beyond that, that's it. And that's when you start to see the relative moves between yields, the relative moves between interest rates coming into play and shifting in the opposite direction, where the Swissy or the SMB has nowhere to go really in terms of rates, whereas we are expecting to see further downside in terms of the ECB rates. So let me just put this into full screen. We can see here that the euro has been rolling over against the Swiss franc of late. The trend, certainly since this peak back in May, is a bearish one. So we can see we've got that first pullback here into the 61.8. And then the next pullback here has taken us above that 61.8, once again, somewhere in between the two. So whilst we're seeing a little bit of upside for the near term, the bearish trend is clearly defined over the near term. And with the expectation that we're going to see a particularly weak inflation gauge from the Eurozone this coming week, we could see further downside. A move up through the 0.949 level would point towards a near-term rebound. And certainly if we were to see inflation sort of disappoint on that front, then potentially we do see some upside. But I think there's a good chance we do see another move lower for Euro Swissy as we continue to roll over and move essentially in line with the bearish trend that has been playing out over recent months. So Euro Swissy, the key market that I'm going to be following for this event. And finally, I wanted to highlight the outlook for Australia. Australian interest rates have been an interesting one, because whilst we have been looking elsewhere, the likes of their Fed, the likes of the ECB, the Bank of England, and the RBNZ, the Bank of Canada, all expecting to cut rates this year. Well, the RBA at a time, there'd been a view not so long ago that we might actually see them hike rates once again. And so the question mark is that the case? Are we actually starting to see them moving in the direction of the other central banks, and we see a sort of kickback in terms of that move? Well, that is actually what's playing out. Now, you can see here the 3.6% expected on that monthly CPI indicator. So there's an expectation that we do see further disinflation. Still relatively elevated. Headline inflation at 3.6% doesn't necessarily fill you with confidence that they're suddenly about to cut interest rates. But nonetheless, we are seeing some movement. You can see here in terms of the 3.8% that's currently in play for Australia, well above many of the other major economies that we follow. You can see below that 3.3 for New Zealand, 2.89 US, 2.6 Eurozone, 2.2 for the UK, and like I said with Switzerland, 1.29. So certainly they don't have a problem when it comes to inflation being above target. So Australian inflation expected to move towards the downside. The question mark is whether that really moves the dial. Now, market expectations for the RBA do point towards a potential rate cut this year, and that would come in December. Like I said, that is a shift from where we were not so long ago, where people thought it was more likely we'd see a hike than a cut. So moving in the right direction. Certainly, if we see a greater inflation, a greater decline in terms of inflation, that could further the cause for that rate cut in December or a potential rate cut in November. So certainly that's why we think this one's going to be a particularly interesting one to follow. But nonetheless, we're also looking at a central bank that's likely to be holding off while other central banks are raising rates. And certainly if we see inflation coming up above estimates, then you see a further cause for them to hold off. And we can see in terms of the chart here for the Australian dollar against the Canadian dollar, certainly a big commodity focused pair. We can see that we've been moving towards the upside of late, in part driven by the weakness that we're seeing in terms of the energy markets, weakening that Canadian dollar. But nonetheless, the 4-hour chart highlights this sort of uptrend that's been in play of late. Do we have sort of trend line? I'm not sure that we do, to be honest, but I think that might have been broken. There you go. Yeah, so we've been broken on that front. But essentially, really what we're looking at here is the continued creation of higher lows, as we can see here. So as it stands, the pullback we're seeing looks like a retracement of the rally from 0.90172, which is this swing low here from mid-August, August the 15th. And so, yes, we're pulling back at the moment, but if we were to see a stronger than expected Australian inflation gauge, we could see another pop in terms of the Aussie CAD. If we would see a weaker number, maybe we see further downside for this as we start to reverse the expectations around the RBA, or we continue that reversal. In terms of the hourly time frame, it gives you a little bit more granularity to be able to sort of base your trades around, because you can see here this nice pattern of lower highs and lower lows, which means as long as we remain below this 0.916, we do have the possibility of rolling over once again and continuing this near-term pullback. But like I said, we're still waiting for this announcement to come out and the volatility that would come around that. But the wider trend does point towards a possibility that this near-term pullback is a potential precursor to the bulls coming back into play once again for the Australian dollar against the Canadian dollar.